With the Reserve Bank of Australia raising the cash rate this month by more than many market commentators were expecting, and inflation marking its highest reading since the introduction of the GST in the early 2000s, everyone now seems to be talking about how high interest rates are going to go, how high inflation is going to go, and how much property markets are going to fall. Now, sure, the Reserve Bank's decided to go early and go hard with rate rises in an attempt to control the highest inflation in decades. But what does it really mean for our housing markets? That's what we're going to discuss in this week's Property Insider Chat with Dr. Andrew Wilson. But if you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel and click the little bell icon so we can inform you each time a new show comes out. Hi, Andrew.
Hi, Michael. Yes, some very interesting news from the Reserve Bank. We certainly anticipated another increase, and a little bit of a surprise perhaps that the Reserve Bank decided to move away from its traditional 0.25% increment, and it's doubled that with an increase to 0.5%, which takes the official rate up to 0.85%. In fact, the increase, Michael, was the sharpest increase in official rates since the year 2000, where we had issues because of the introduction of the GST, which spiked prices in the short term. The only higher increase that we have had was way back in 1994, where interest rates increased by 0.75%. So this is a significant increase in the historical sense. The question is, will it work, and how high does the Reserve Bank have to go? That's the balancing act between creating an economic downturn and higher unemployment and controlling inflation. So it's a trade-off between one devil and the other devil. So it's going to be an interesting ride.
Sure. Well, obviously, the higher interest rates are to reduce demand in the economy. In other words, to slow down the inflation that we're having. But there is, as you say, the clear risk that if you reduce the demand too much and people can't spend, businesses are going to have some challenges, and what's they going to do to unemployment. But I think in the short term, the economy is well placed for the higher interest rates. We've got record low unemployment, slightly rising wages. Average households well ahead in their mortgage payments, and the saving levels are high. But I guess it just depends how high and for how long.
Well, that's right, Michael, but we are in a strong position to start with, but that's what got us into this high inflation to some degree. It was the COVID stimulus packages, which worldwide have created demand well in excess of supply, which has created those higher prices initially, particularly from oil. I noticed the get out of jail card for politicians now is calling it the Putin oil increase. Well, oil was on the way up strongly before the Ukraine war. That certainly exacerbated it. But it's a bit of a political scapegoat, is to use the Ukraine war.
Well, very much so, Andrew. If you think about it, the last quarter results that came out was March, and the war only started in February. So much of the inflation Australia has already occurred before the war started.
And oil supplies hadn't been impacted materially early days in February and March. But as I said, it now becomes a political game, because this is something that's going to impact political outcomes. And of course, the US are front and center in blaming Putin for higher oil prices. The government there is facing a very pessimistic midterm election come November this year. So, and inflation is really biting hard in terms of sentiment. The party in power, the Democrats, are trying everything to get the attention away from inflation and high fuel prices and going back to the safe old card of let's get Trump. But I don't think that's going to work, because this is a very severe inflationary environment. In fact, the latest monthly data out of the US was really terrible. No sign of any control. In fact, it was up higher, 8.7% over the year, 1% over the month. Inflation increased by the US. So that's annualized 12%. And these are the highest results in 40 years in the US. And we will likely follow that pattern. It's interesting that we can say that the Australian economy is in good shape and the US economy is in good shape. And the Reserve Bank is telling us that, well, it's okay. We can raise rates because we've got high savings that are falling, obviously, but we've also got full employment and wages are rising. But that's not what the Reserve Bank wants. I'm not sure why they're using that as an exemplar, because in terms of their strategies, because they actually want to see reduced demand. And reduced demand will only come if you're getting an impact on your household budget, because your savings have gone and wages are not keeping up with prices. And as you said, Michael, the end game here is for employers to have less demand than they've got now. It's a fine balancing act when you get to the point where employers say, well, we haven't got enough demand, so we'll have to start shedding labour, and that means higher unemployment. As I said, I think that the offsets that we have early days, of course, are positive, but that's not the point. The point is that the Reserve Bank doesn't want those offsets. They want demand to start to fall, and because that's the textbook strategy for reducing inflation. Maybe it's now the reverse of what we saw a few years back when lower interest rates weren't reinflating the economy. Maybe now we're going to see, and all the economists were questioning, why isn't this working? This is what the textbooks tell us. And now, of course, we're at the reverse, where galloping inflation is in prospect. And will higher interest rates work as the textbooks say that they are supposed to? But as I said, it's a very uncertain outlook, but not so uncertain are the, as you alluded to, the usual headlines regarding house price crashes. That's probably the one thing that we have more certainty over, is the fact that house prices won't crash. They haven't crashed before, so why would they crash now? And certainly the winter season is upon us, and we will see that the quieter period exacerbated by the fear factor. But we saw that back in 2018 and 19. And eventually the markets regained confidence because nothing had really changed in terms of underlying supply and demand. And I think going forward, we can still look forward, even with higher rates, to a reasonable spring selling season. But it's grist to the mill for clickbait. Lots of clickbaiters are out there in force with their usual predictions, and we await the revisions to those usual predictions.
Now, there's no doubt the markets will correct, but that's very different from crashing. Property price cycles are normal, Andrew, and we have survived housing downturns before. Borders are opening, good quality properties will still sell. And it's interesting, I was doing some research over the weekend to write something about this, and I found this article, which I wrote, in 2008, should you buy or not? That's the question. And when I read through it, the story was very similar. There was a downturn, people were talking about recession, about rising interest rates, and the question was, should you sit on the sidelines or not? Imagine if you sat on the sidelines in 2008 and missed out the huge growth that had happened. But we'll be hearing those clickbait headlines for quite some time. Now, there was some interesting news from the New South Wales government. We know there's a shortage of apartments. We know there's a shortage of properties, particularly in New South Wales with rising rents and very low vacancies. And now the New South Wales government is going to slug foreign investors further. They've already got a surcharge on their land tax, and they're going to increase it again. And they're talking about it on the basis of, well, that's okay. People from New South Wales will benefit from the foreign investors because we're going to tax them more, and we're going to actually help it pay our health bills.
Yeah, but isn't that a disincentive to develop and to invest? Higher costs? I mean, there was they remember when they first introduced that higher tax for foreign investors, you know, there was a lot of gobbledygook scare headlines, which was very xenophobic back when there was a lot of investment, particularly in Sydney apartments. And we had a boom then back in 2017. And the blame game was up and running that it was because of foreign buyers, which was absolute nonsense. But don't let the truth get in the way of a scary headline, and was something that became xenophobic political grist to the mill. And looks like we're back to it to some degree. But the last thing we need is to reduce supply of dwellings in New South Wales, in Sydney particular. Rents for houses are now up 25%, Michael, as we saw in our latest rent report, up 25% for houses in Sydney over the past year. Unit rents are now up 20%. Coming from a low base, of course, because we know we had a notionally oversupplied market through COVID in inner city Sydney units. Now we're nearly 50% down on what we built back in 2015, and the rental crisis, I don't use these words without some care, is clearly emerging. We've tracked, Michael, just over the last week that Sydney house rents have increased by another 10%. So I'm not sure what the government's on about and how they'll answer the question when we start seeing more and more people, unfortunately, unable to find accommodation. And the profiles of those that can't find accommodation will be a little bit different to the marginalised we unfortunately do see unable to find housing. And I'm not sure what the New South Wales government's answer is going to be to that. We're already seeing some severe political repercussions, particularly in California, because of their terrible housing crisis, and it is a crisis there. And now local governments are paying a very heavy price for ignoring the need for more housing. So I'm not sure why what we're doing, creating a tax that will create less demand for a product that is sorely in short supply, particularly in the Sydney market. And again, it's just a disincentive and another disincentive for overseas buyers. And I think the other point is, I do remember back when it was first introduced during that xenophobic period, that a lot of, particularly the Chinese investors, were quite miffed that this seemed to be directed particularly at them for some reason. But we need more investment, not fewer investment, because the whole point is an overseas investor, unless they have residency, can't live in the property. All they're doing is providing investment in the country and more supply, and we absolutely need more supply. We need hundreds of thousands of extra dwellings in Sydney, Michael, and in most other capital cities as well.
Well, it's just another nail in the coffin of future apartment towers, because higher costs, more difficulty getting finance, difficulty getting trades and materials, means that even some of those towers on the drawing board are not going to go ahead. So you're right, we are going to have an ever increasing rental crisis. Now, Andrew, over the weekend, there was a long weekend in the two big auction markets, Melbourne and Sydney, not really some in Brisbane, produced mixed results. Clearly, there weren't as many properties up for auction, and people were taking a long weekend, the beginning of the snow season down here in Melbourne. So how did the auction market respond to the long weekend?
Well, I thought they were quite reasonable results, Michael. Melbourne and Sydney were steady, not too far away from the previous weekend. Sydney was up a little bit, Melbourne was down a little bit. Brisbane was down quite sharply, but that's been a bit of a volatile market over the last few weekends. Adelaide was up strongly, but that, as we know, is Australia's strongest capital city market at the moment. And Canberra following, as we expect, Sydney and Melbourne downwards, because they were a lot earlier in their growth cycle. So I thought the results were quite reasonable, Michael, given the long weekend. We would usually see them lower. And of course, the other factor is we had the bad news that with the interest rate increase, that sharp interest rate increase. So it was around about where it's been for the last few weekends. However, as you said quite clearly, Michael, numbers were quite low. In fact, well below the same holiday weekend last year, where we were starting to get issues with COVID re-emerging a year ago. If you remember back to those gloomy times, I don't think we want to remember that, but numbers were quite low. And I think that's going to be the trend coming forward, Michael, will be that sellers will increasingly sit on the sidelines. This is what we see during the sort of the fear campaigns that we've had previously, 2018, because sellers obviously have more skin in the game. They've got, in a sense, more to lose or more to consider in terms of engaging the market, but certainly sellers will be lower on the ground. We saw that with the numbers quite low in Melbourne, particularly around about half the numbers that they had a year ago. Sydney lower also.
But clearly, Andrew, there are markets within markets. So you were just talking about the Sydney property market, but every Sunday morning you're out there with a breakdown of regions for Sydney and Melbourne for houses and units, and that comes out on your LinkedIn every Sunday, and we report it on Property Update. And that clearly shows at the moment that there are some areas of the Sydney auction market that are performing much, much stronger than others. So one has to get much more granular at times like this, doesn't one?
Yes, that's right, Michael. And typically, as an example, for the holiday weekend just past, we had a very small proportion of the mid to higher priced properties, because they're the sellers that typically, and buyers that are typically distracted by holidays. We don't read a lot into clearance rates there. Look, I think it's important to look at the regional breakdowns, not just the capital city numbers.
Interestingly, in Melbourne this weekend, apartments units had a higher clearance rate than houses. But having said that, it was really only a very small number.
Of course, we've had a lot of growth, a lot of activity, a lot of demand's been brought forward. So a lot of demand's been satisfied, but there are some positive drivers that will be, I guess, in a sense, interest rate neutral, and that's first home buyers and investors. First home buyers, of course, have got those packages that have been released. First home buyer deposit scheme has now got 50,000 places per financial year. And of course, investors will be chasing those higher rents. The share market, expectedly in a high inflation, higher interest rate environment, is starting to look a little wobbly. So we're in for a winter of discontent to some degree, if I could use that term, but it's only really the fear factor. And as someone once famously said about the Australian housing market and other things, there is nothing to fear but fear itself. So I'll run with that line again.
So no doubt there will be fearmongers. The media is going to keep giving us those negative headlines because, as you said earlier on, they're clickbait. So I look forward to having a chat with you each week, and let's bring some perspective to the market, Andrew.
Yes, thanks very much, Michael.